Big news that came out today, came out before the weekend, is that the U.S. just lost its last perfect credit rating. And so, I went back and as a pattern trader, I wanted to see, well, first of all, when was the last time we downgraded? And that was back in 2011. And so I want to look at the patterns on these as well. But before I do, what actually happened? So what happened on Friday after the markets closed is that Moody's downgraded our U.S. government debt from AAA to AA1. All right. That was the third and last of the major credit rating agencies to downgrade the U.S. government from a perfect score. Right. S&P downgraded us from AAA to AA plus back on August 5th, 2011, and Fitch downgraded the government's rating from AAA to AA plus on August 1st, 2023. So, again, we can look at these. There's not much to look at in terms of a pattern. I need, you know me, I need years of recurring patterns. I need a lot of data of recurring patterns before I can call it a pattern. But we're going to take a look at them. But also over the weekend, the Treasury Secretary came out, and Scott Bessent said this. He said that Moody's ratings were a lagging indicator. He has a point, by the way, and I think all credit ratings seem to be a lagging indicator as well, but Moody's is the lagging of the three as well. Deficits under last administration were the highest outside of wartime and a recession. So if Moody's was really going to bring things into more perspective, I think they would have downgraded back when Fitch did in 2023. Current administration's policies to bring down spending, increase growth, that's going to help, and what's causing the concerns and why Moody's came out and did this in the first place. So the markets today opened up down around 1%, but it has climbed back since, and I've even seen the Dow kind of pushing the green a little bit. Looks like it's doing it as I'm speaking. The others are a little bit behind. Let's say the S&P and the NASDAQ are lagging the Dow. Okay, so not much to talk about there, but if you look at the window, this is the year. Here's where the high was coming into the year was 620 on the S&P. Here's where we are coming into today, and if you blow that up, this is what it's looking like. We did come down to about the middle of where Thursday was, but we've come back since then. The bond market, which is a lot of the cause of what's happening with the stock market, is that we saw 10-year, 30-year, and 2-year bonds move higher, right? The 10 years at a little over 4.5. The 30 years, what's causing people to be concerned is it's now above 5, which means if this stays around here for any length of time, we're going to see mortgage rates going up as well. Not good for especially first-time home buyers. I mean, I saw some reports came out, first-time home buyers, that's just absolutely insane. That so few of our Gen Z Gen Z are able to buy a house with the average home prices where they are today. If you look at gold, nothing's really changed there, still bullish opportunities, but I want to get to the downgrade. So back in 2011, you see the black line that I have here on the screen. This is when Moody's downgraded back in 2011. And you saw what happened. We literally went down quite a bit, and we dropped almost double digits the day of the downgrade and the day after. Then we kind of moved sideways, rolled back over again before proceeding higher. That was a 10% drop. That happened the 2 months after the 2011 downgrade. Now take a look at the 2023 downgrade. This was a little bit different because you got to remember what was going on in 2023. We were already in high inflation. We were already raising interest rates, and you can see that this 10%, part of this was because of what was going on to adjust for inflation, but also that downgrade didn't help matters at all either. So my conclusion to what we're seeing in the markets this week, and we still have a lot to go. We still have a lot of news that I think is going to take the place of the Moody's downgrade. But in concluding with the Moody's downgrade, we already were in a correction, like I said, in 2011, right? After the downgrade, we fell an additional 8%. In 2023, we were already in the beginning a multi-month correction because of inflation. But the downgrade from Fitch didn't help matters. In both cases, we had initial market reaction, then we had a bit of a pause, and then the correction took months to play out. So, could this happen? Yeah, most certainly could. When would it happen? It might take a couple months before it begins. And I'm going to show you next week some data that I believe is not lagging, that has to do with what's happening, what I believe is going to happen this summer. So stay tuned for that. And that will be what I call my leading indicators coming in to the summer.